United Parcel Service is navigating a complex landscape in 2025, but recent signals suggest the company may be turning a corner. In the third quarter, UPS reported revenue of approximately $21.4 billion, outperforming the market's expectations. Adjusted earnings per share came in around $1.74, well ahead of consensus estimates around $1.31. These results arrived alongside an aggressive cost restructuring effort. The company announced that it had cut about 34,000 jobs and closed 93 buildings so far this year, and it expects total annual savings from these efforts to reach about $3.5 billion. Investors rewarded the report with a stock jump of more than 12% in pre-market trading. But as always with UPS, the devil is in the details. While revenue and adjusted EPS topped expectations, the underlying global parcel and freight volume environment remains soft. Domestic volumes are under pressure as e-commerce growth decelerates and customers shift shipping patterns. Internationally, growth is improving, but margins are thinner. UPS's long-term challenge is balancing volume mix shifts, pricing power, network cost reduction, and capital investment in logistics automation and green infrastructure. One of UPS's strategic levers in this turnaround is the reconfiguration of its network to become more nimble and cost-efficient. The company is cutting its dependence on high-volume, low-margin customers, most notably reducing its shipment volume for Amazon.com, Inc., its largest customer, by more than 50% over the next few years in order to focus on more profitable logistics flows. At the same time, UPS is investing in automation, robotics, electric vehicles, and advanced tracking in order to reduce per-package cost over time. The job and facility cuts cited earlier reflect the difficulty of labor and real estate cost structures in legacy parcel networks. Another growth driver is UPS's increasing exposure to higher-margin logistics segments such as healthcare, global trade lanes, and cross-border e-commerce. The company has emphasized its cold chain offering, pharmaceutical logistics, high-value package delivery, and integrated supply chain solutions. These areas grow faster than standard parcel business and are less volume elastic. One scenario is that as core parcel volume growth slows, UPS can offset revenue pressure through higher unit revenue, improved mix and cost-based reductions. From a financial health perspective, UPS is reasonably well-positioned given its earnings surprise and cost savings programs. The company continues to pay a reliable dividend, which adds a layer of income support while investors await structural improvement. One concern, however, is that the macro environment remains uncertain. Consumer spending is challenged, global trade faces tariff and geopolitical risk, and logistic cost inflation, including fuel, labor, and real estate, remains a headwind. Valuation is interesting. With the recent earnings beat, UPS may warrant a higher multiple, but the risk remains that much of the improvement is front-loaded cost savings rather than volume expansion. Investors should closely monitor the next quarters for volume trends, margin progression, and capital expenditure discipline. If UPS succeeds in stabilizing margin expansion, improving revenue growth, and executing cost reductions, the stock could deliver compelling returns. Conversely, if volumes continue to decline or cost savings plateau, the valuation may compress. Given the current mix of opportunity and risk, my recommendation is that UPS is a modest buy. For investors who believe in the structural repositioning of parcel logistics, who are comfortable with a multi-year horizon, and who appreciate dividend yield plus cost savings upside, UPS offers a favorable risk-reward ratio. I would advise sizing the position appropriately and monitoring key milestones: volume growth or stabilization, cost savings realization, margin expansion, and execution of the network transformation. In closing, UPS is not a speculative fast growth ideal. It is a mature logistics heavyweight reforming itself for a new era. If it delivers on its strategic initiatives, the long-term payoff could be substantial. If not, the margin of safety remains because of the dividend and cost program, but upside may be more limited. If you found this video helpful, Please like, subscribe, and hit the bell icon so you don't miss future deep dive stock analyses.